Building your first $5,000 portfolio is an exciting and pivotal step in your financial journey. Whether you're just starting out or looking to take control of your financial future, this is a moment where you can lay the foundation for long-term wealth building. The thought of investing may seem overwhelming, especially when you hear terms like stocks, bonds, and mutual funds being thrown around. But in reality, the process is more approachable than you might think. By understanding some core principles and adopting a smart strategy, you can build a diversified and effective investment portfolio that sets you up for success. When you're starting with a $5,000 investment, it's important to focus on two main principles: simplicity and diversification. These are the bedrock upon which you will build a solid portfolio that has the potential to grow over time. Now, let's take a step-by-step approach, breaking down the process of how you can go from the initial investment to a well-structured portfolio that reflects your goals, risk tolerance, and time horizon. Before you even make your first investment, it's crucial to ask yourself, what are you investing for? The answer will shape the way you approach your portfolio. Are you saving for retirement, a down payment on a house, or perhaps just general wealth building? Your goal will determine your time horizon, and your time horizon influences how much risk you're willing to take. If you're in your 20s and investing for retirement decades down the line, you might be willing to take on more risk in hopes of higher returns. If you're planning to use the money in the next few years, you'll probably want to choose more stable, conservative investments. Once you've identified your goal and time horizon, it's time to think about risk. Understanding your risk tolerance is essential, especially when you're just starting out. The beauty of investing is that over time is proven to generate positive returns. But there are short-term fluctuations in the market. You need to be prepared for ups and downs and determine how much volatility you can comfortably tolerate. Remember, the longer your time horizon, the more risk you can typically afford to take because you have time to recover from market dips. However, if your goal is more immediate, you might want to lean towards safer, more conservative investments. When it comes to investing your first $5,000, one of the most effective strategies is diversification. Diversification is essentially spreading your investment across different types of assets to reduce the overall risk of your portfolio. By doing this, you can ensure that if one part of your portfolio suffers a loss, the other parts may help to balance it out. Imagine not putting all your eggs in one basket. This approach lowers the chance of your entire portfolio being wiped out by one poor performing investment. For a $5,000 portfolio, the key is balancing different asset classes: stocks, bonds, and perhaps even some alternative investments. If you want to invest in stocks which offer the potential for higher returns but also higher volatility, a good rule of thumb is to allocate a portion of your portfolio to stocks that represent both growth and value. Growth stocks are typically companies with a lot of potential for future growth, while value stocks are established companies that may not be growing rapidly but are considered undervalued by the market. Alongside your stock investments, you should also consider including bonds in your portfolio. Bonds are generally safer and provide consistent, though lower returns compared to stocks. Bonds can act as a stabilizer, helping to balance out the risk in your portfolio. If you're looking for safer, more predictable income, you may want to allocate a portion of your $5,000 to bonds, especially if you're more risk averse. There are different types of bonds, such as government bonds, municipal bonds, or corporate bonds, each with its own risk profile. Generally, government bonds are the safest, while corporate bonds carry more risk, but also the potential for higher returns. Another option for beginners is to look into exchange-traded funds, ETFs, or mutual funds. These funds allow you to invest in a diversified basket of stocks or bonds, giving you exposure to a wide range of assets without the need to buy individual securities. This is a great option if you're looking to keep things simple and want to avoid picking individual stocks or bonds. You can buy ETFs that track the entire stock market, specific sectors like technology or healthcare, or focus on bonds or international investments. This approach helps to achieve diversification even with a smaller portfolio. So with $5,000, how should you distribute your investments? A balanced portfolio for a long-term investor might allocate around 80% to stocks and 20% to bonds. This provides exposure to growth with a buffer of safety through bonds. Of course, this will depend on your risk tolerance. If you're someone who can stomach market volatility, you might tilt the scale more heavily towards stocks. If you prefer more stability, you might allocate a larger portion to bonds or even consider adding some cash or cash equivalents, like a money market fund for safety. Once you've decided on how to allocate your portfolio, the next step is selecting the specific investments. One of the most popular and beginner-friendly choices is to invest in low-cost index funds or ETFs. These funds track a broad market index like the S&P 500, which is made up of 500 of the largest and most stable US companies. This type of investment is a great way to gain broad exposure to the market with minimal effort and cost. By investing in an index fund or ETF, you're essentially betting on the long-term growth of the entire market, which has historically delivered positive returns over time. Alternatively, if you prefer more targeted investments, you could focus on specific sectors that interest you. For instance, if you're excited about technology, you could choose a technology-focused ETF. However, it's important to remember that investing in individual sectors can sometimes increase risk if the sector underperforms. Now let's talk about the mechanics of investing. Most brokers today make it very easy to start investing, and many offer no-fee accounts for small investors. If you're looking to keep costs down, you should shop around for a platform that offers low or no fees for transactions and account maintenance. Some popular brokerage firms cater specifically to beginner investors and provide educational resources to help you along the way. Once you've set up your account and selected your investments, it's time to begin investing. A key part of successful investing is consistency. Try to avoid the temptation to time the market or react emotionally to market fluctuations. It's easy to get caught up in the daily ups and downs, but a successful investor takes a long-term perspective. Regularly contributing to your portfolio, even if it's just small amounts, can lead to significant growth over time through the power of compounding. Another important factor to consider is rebalancing your portfolio periodically. Over time, as the value of your stocks and bonds change, your initial allocation may no longer be accurate. Rebalancing means adjusting your investments to return to your original target allocation. For example, if your stock investments grow to 90% of your portfolio, but your goal was to have only 80% in stocks, you would sell some stock and buy more bonds to get back to your target allocation. This helps maintain the risk profile you're comfortable with and ensures that you don't take on more risk than you intended. As your portfolio grows, it's also important to stay informed about changes in the market and in your personal financial situation. For example, if you get a promotion at work or experience a major life event, you may want to adjust your investment strategy to reflect these changes. Likewise, regularly reviewing your portfolio to ensure it aligns with your goals will help you stay on track to meet your financial objectives. In conclusion, building your first $5,000 portfolio is an exciting and important step toward financial independence. It requires thoughtful planning, an understanding of your goals and risk tolerance, and a commitment to staying the course. Diversification, simplicity, and consistency are your best tools for success. By taking a balanced approach and focusing on long-term growth, you can turn your $5,000 into a solid foundation for future wealth. Remember, investing is a journey, and even small steps today can lead to significant rewards tomorrow. Don't be afraid to start. Your financial future is worth it. When you're building your first $5,000 portfolio, one of the most powerful strategies you can adopt is diversification. By spreading your investment across a variety of asset classes, such as stocks, bonds, and ETFs, you reduce the risk of putting all your money into one place. The idea is simple. Different assets react differently to market conditions, so by holding a mix of them, you lower the chances that your entire portfolio will suffer a significant loss if one investment performs poorly. For example, stocks are generally riskier but offer higher potential returns, while bonds tend to be safer and provide steady income, though with lower returns. ETFs, which are funds that hold a diversified collection of stocks or bonds, can further help by offering exposure to entire markets, industries, or regions without needing to pick individual securities. This diversified mix ensures that you're not overly exposed to one investment that could drastically impact your portfolio's value in the short term. At the same time, simplicity is key. While it's tempting to try and pick the next hot stock or market trend, keeping your portfolio simple and focused on broad, diversified assets can make your life much easier. Choosing ETFs that track major indices like the S&P 500 or a total market index allows you to invest in a wide range of companies without the need to research each one individually. This approach also minimizes the time and effort you spend managing your portfolio, which is especially important for beginners. In short, the combination of diversification and simplicity in your $5,000 portfolio helps create a balanced approach. You'll have a mix of assets that can weather different market conditions, and you won't be overwhelmed with the complexity of constantly managing multiple individual investments. This strategy is both practical and effective for long-term growth. Before you start investing your $5,000, it's essential to first understand your financial goals and risk tolerance. Your goals will guide your investment strategy, while your risk tolerance will help determine the types of investments that are most appropriate for you. If you're saving for a long-term goal like retirement, you might be more comfortable with investments that have higher growth potential but come with more short-term volatility, such as stocks. On the other hand, if you're saving for a short-term goal like buying a home in a few years, you may want to focus on safer investments such as bonds or a mix of low-risk ETFs to ensure your money remains stable and accessible when you need it. Risk tolerance is a personal decision that depends on your comfort level with market fluctuations. Some people are comfortable with the idea of seeing their portfolio value drop temporarily, knowing that it could rise again in the long term. Others, especially those with shorter time horizons or lower risk tolerance, might prefer more stable investments that offer consistent returns but without the same growth potential. It's important to honestly assess how much risk you're willing to take. If the thought of your portfolio losing value stresses you out, it may be best to keep a larger portion in bonds or cash-like assets, even if it means lower returns. Aligning your investment choices with both your goals and risk tolerance is crucial for staying on track and avoiding the temptation to make impulsive decisions during market downturns. By carefully considering both factors, you ensure that your $5,000 portfolio is designed in a way that suits your needs and financial future, allowing you to invest confidently and with a clear purpose. One of the most critical factors in building a successful portfolio is consistency. Investing isn't about trying to time the market or making emotional decisions based on short-term market fluctuations. The real key to success lies in sticking to a strategy, making regular contributions, and maintaining a long-term focus. By committing to regular contributions, no matter how you harness the power of compounding, which is the ability of your investment to grow exponentially over time as earnings generate their own earnings. Even with a relatively modest initial investment, regular deposits and reinvested dividends can have a significant impact on your wealth. It's easy to get distracted by the ups and downs of the market, especially when you're just starting out. Stock prices can be volatile, and there will be times when your portfolio drops in value. However, reacting emotionally to these fluctuations can lead to poor decision-making. For instance, panic selling during a market dip may cause you to miss out on future gains when the market rebounds. By focusing on the long term and sticking to your investment plan, you can avoid making these knee-jerk reactions. A key component of maintaining consistency is rebalancing your portfolio periodically. Over time, some of your investments will perform better than others, causing your initial allocation to shift. For example, if stocks have done well and now make up a larger portion of your portfolio than intended, rebalancing involves selling some of those stocks and reinvesting the proceeds into other assets, such as bonds, to maintain your desired risk level. This discipline helps keep your portfolio aligned with your goals and ensures that you're not taking on more risk than you're comfortable with. By consistently contributing to your portfolio and staying focused on long-term growth, you can take full advantage of compounding and position yourself for financial success in the years to come.